everyone, Marc Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. I want to talk about an important topic today, a company's fiduciary duty to shareholders.
Duty.
Grow up. At the end of this video, I'm going to tell you about a company I believe is violating its fiduciary duty, so you want to stick around for that. Now, let's talk about what fiduciary duty is. According to law firm Latham & Watkins, a company's fiduciary duty is twofold. One, the duty to make careful, informed decisions by assuming an active role throughout the entire decision-making process. Two, the duty to act in the best interest of the corporation and its stockholders by not putting any personal interest ahead of the interests of the corporation or its stockholders. So it's basically to act in shareholders' best interest. After all, as a shareholder, you're an owner of the company, and management and its directors work for you. Doesn't always feel that way, but that's the way it's supposed to be. And unfortunately, there are a lot of gray areas when it comes to fiduciary duty. CEOs often do act in their own self-interest, and they may justify it by claiming that it's what's best for the company, but occasionally it's pretty transparent. For example, CEOs and other managers are often incentivized by certain metrics, such as earnings per share or stock price. So the CEO, for example, could manipulate things to ensure that the company's earnings per share hits a certain target or the stock price climbs. Here's what I mean. Stock buybacks are the easiest way to do that. When a company buys back shares, there are fewer shares outstanding, yet if the earnings don't change because there are fewer shares, the earnings per share goes up. So for example, let's say a company earns $10 million in a year and has 10 million shares outstanding, it earns $1 per share. And let's say the stock is trading at $20 or 20 times earnings. Now, the CEO has a clause in their contract that says if they grow earnings per share by 10%, or if the stock hits $24, they get a $5 million bonus. So what does the CEO do? CEO convinces the board to authorize a 1 million share buyback, which it does, lowering the total outstanding shares to 9 million. Now, the following year, earnings are flat. They don't grow at all. But because there are only 9 million shares outstanding now, that $10 million in earnings comes out to $1.11 per share, which is 11% earnings per share growth. So the CEO gets the $5 million. If the stock has the same valuation as 20 times earnings as it did previously, it now trades at $22.20. But hold on. Because the company showed 11% earnings per share growth, the market assigns a higher valuation to it. And so now it trades at 22 times earnings. And so the stock price is $24.42. And the CEO, again, gets the $5 million bonus. And this kind of thing happens all the time. And shareholders won't complain because the stock price is higher, right? So no harm, no foul as far as they're concerned. Or how about when a CEO announces a stock buyback while he's dumping shares himself? This happened in 2018 when Home Depot CEO Craig Menear announced a $4 billion stock buyback. The very next day, he sold nearly 114,000 shares, pocketing $18 million. Now, if the stock was such a bargain that was worthy of him spending $4 billion worth of shareholders' capital, why was he selling his own shares? The most egregious case of a breach of fiduciary duty is happening right now with a company called MicroStrategy. This is a business analytics company that has completely changed its business model to now buying and holding Bitcoin. It currently owns $4.5 billion worth of Bitcoin and recently sold $1 billion worth of debt to buy more Bitcoin. Now, keep in mind, this is not a decision to accept Bitcoin or to diversify into Bitcoin like Tesla did. Tesla's main business is still building and selling cars and solar walls. MicroStrategy's main business now is buying and holding Bitcoin. Now, look, maybe Bitcoin goes to $100,000, maybe it goes higher, and MicroStrategy makes a ton of money. But changing the business model to bet on a volatile and speculative asset is not being a proper steward of shareholders' capital. Now, what's amazing to me is not that the CEO wanted to do it. People come up with bad ideas all the time. What's incredible is that the board of directors, again with this fiduciary duty to shareholders, they looked at this plan, they consulted with experts, theoretically, they deliberated it, and then they ultimately agreed to this harebrained scheme. Now, is this acting in the best interest of stockholders?
Nope.
Now, many people think that management and the directors will run the business the best way they know how. But remember, they have a legal obligation to do that. When they breach that fiduciary duty, you should be aware of it, and that's a stock you should probably avoid. Now, if you want to learn more about the MicroStrategy story and why I think it's the biggest short in the market, or for other wealth and income building ideas, just click on the link below to check out my free e-letter, Wealthy Retirement. Thanks for watching State of the Market. I'm Marc Lichtenfeld. I'll see you next week.